And do it, and we do it when you're done. And and hold it, and we'll prompt you to do that. And that's it. Have a good meeting.
Thanks.
See, I would have had to have taken notes.
Well, I'll get help. I got this guy here who's a great guy. Okay, the meeting of the Lincoln Trustee of Trust Funds will now come to order at 10:05. Couple of things to say before we turn everything over to Terry and Donna. First, welcome to my colleague that's here, and welcome to our bank representatives that are here. Sorry that our new member Matt is not here. He's in Virginia with a grandmother who's not feeling well, so we wish her speedy recovery and Matt a safe trip back. Also, there was a mistake on the agenda apparently. That some people might have thought we were at Bank of New Hampshire's office in Lincoln today. We are not. We're at the town hall. We apologize for that. Normally we are here. We were at the Lincoln branch during the trouble with the virus. We used to meet there then because the town hall was closed for quite a bit. But it's a great little meeting room there upstairs they have.
Yeah.
That's a great, nice and roomy and good. And we did have a couple of visitors there too. And let's see, was there anything else? Oh yeah, we wanted to congratulate Mike Simons, who was reelected to the budget committee on Tuesday night as chair. And also, luckily I got reelected to the vice chair of the budget committee, and it's a good team we've had there for 10 years now. It's hard to believe we've been in there for 10 years, but we have been there for 10 years. And one other little note, I had somebody ask me the other day, did the Bank of New Hampshire come to do the wealth management, or did you go to the Bank of New Hampshire? I said, I went to the Bank of New Hampshire 2 different occasions. And thank God that we connected, and they're doing an awesome job with the wealth management, and continues to grow and over the years, and we're very fortunate to have them. That's how I answered that question. And then at this point, we'll turn it over to Donna.
Thank you. Well, again, Frank normally joins us here, but he had a conflict this month, so it was a perfect time to bring Terry, who does all of the, you know, the behind the, she's the wizard behind the curtain, actually. So does all of the sort of accounting for that. So
Just know everybody, Terry is awesome. Paul will tell you that too, with calls, with emails, and she gets right back to you too. She's not one of these ones that, yeah, give me a few minutes, and then 3 weeks later, no, she's right on top of everything. And of course, Don and Frank are too. But just, I'm sorry.
Just a shout out to Terry. We worked together with Amy over at Department of Justice, and got our MS9s and MS10 straightened out, and we did it, you know, in a conference call, and does a big deal.
Yeah,
definitely a big deal for us.
Right.
Thanks to Terry for taking care of that.
so that's behind you now, which is always
like we call it,
and going forward, it should be
fine.
smooth.
Yeah.
Smooth.
Yeah. And I did bring your thumb drive back.
Oh, right. Thank you. Appreciate that. We'll archive good information.
and I just say, so the MS9, that was a historical issue, not something that the Bank of New Hampshire brought.
Good point.
Yeah.
There's no discrepancies or anything like that. Just a little different processes on how we're doing to make sure everything transitioned over smoothly.
Yeah, it's great.
That's right. Paul came in on that, did a fantastic job, and just so everybody knows, it's a MS9's a lot of work.
Yeah,
They can be, yes.
They have a lot of patience, and I know you did the ones for the all columns you're doing, right? 13.
About 13.
Yeah, about 13. Yeah. So you could, we're preaching to the choir here. Okay.
and I bet sometimes everyone has a little bit different process, so it's not always just sort of streamlined in sort of one.
Well, they did make it, I guess, this year when we got that letter, or actually last year.
It made it a little easier.
They eliminated some of that pigeonhole stuff. I know when Jean was on the board, she really said that was really tedious. Everything in little boxes.
very
Thank
much
goodness,
so.
Paul, that was before.
Yeah, that does not sound like my bailiwick.
No. Yeah. That was tedious, but when we got that letter, it was exciting. I know the bank got it, I got a copy of it. And I was excited about it, because I said, it's gonna eliminate some of this, putting everything in a little block, and I never understood that, but it's
Yeah.
the state requirements.
Right,
But we're through it now, it's done, and we can go forward.
So our agenda is going to be sort of normal. I'm just going to speak a little bit, making sure like sort of Frank's introduction, and then I'm actually going to turn it over to Terry, and then I will move on to some of the an economic update, geopolitical, obviously a lot going on, and then a review of the portfolios. So we just normally want to start off making sure that you're getting everything you need, that you're happy, that and that it's everything set up now for Matt to receive everything. I think Frank is that he's supposed to be receiving anything, and
I haven't heard that he isn't getting anything. Well, we're gonna call it state.
Paul, you have access, right?
I have access.
Yeah.
And Matt and I went over, Matt now has access to the state things.
okay,
I'm not, I honestly can't say for if he does have access to what I have access to.
he doesn't, as far on our system, no.
Okay,
No,
right.
because I don't have any of his information. Actually, I brought paperwork
Yeah.
that he needs to complete for us.
And I think it'd be nice to have him on that stuff.
Yeah, it's always good to
He used
have.
to work at one of the financial firms.
Yeah, he's got a good solid background.
Oh,
He
good.
went over that last time.
Edwards or something.
Yeah, and
Oh, A.G. Edwards, probably, yeah.
so got a good financial background.
Right. So he's much more informed than.
Is he
either of us.
retired
Oh,
or?
No, he's not
Oh.
retired.
No.
He just moved on to a different. He's moved on to construction, I guess,
Oh.
actually, to a different field.
Very good. Okay, so things are good, and I'll turn it over to Terry then.
Well, I don't really have much, and I apologize. I wanted to bring the last month's spreadsheet just in case if there's anything you wanted to go over, but I forgot that.
So, well, we got this.
But yeah, we've got that.
And I have some
but if you
statements, I
don't
brought
have any
statements in
questions,
case you have questions, yeah.
yeah, if everything you feel is running smoothly as far as the spreadsheet goes, and
Yeah, I mean, they're pretty self-explanatory. I mean, and functionally, I mean, the only thing I would say, if there's anything, it'd be functionally, but I don't have anything. I don't have a problem with how it's presented or that.
and I think we have worked out when deposits are made that let me know what funds that that they belong in and debit the account and things like that.
Right.
Things
Yeah,
like
I mean,
that.
it is a little awkward, but whenever I make a deposit, I fill out a sheet, give it to the person behind it or the teller, and then she sent it to you.
Yeah.
Which I'm fine with, but in this day and age, it's just like it'd be a lot easier to just take a deposit with a photo or something like that, I mean, that's how I do when I have a third party thing, I just take a picture and it automatically that sort of thing. It's a little easier. It's all good.
Well, we've got a document.
Yeah, no, absolutely.
Right.
Yeah, that's compliance and documentation.
Oh, yeah, do that.
Yeah.
And just as we did bring up, I haven't talked to these people back here, but I do know there's coming down a couple thousand, like $230,000 we're going to be requesting. I can get that exact number on the way out, but that's something that's coming up.
Okay.
That we're going to need access to.
There's always some.
They told it about to me a couple weeks ago, but they haven't at least officially said anything.
Okay. It's well, spring, hopefully now. I'm not surprised. We would start getting requests from.
Right.
That would make sense.
Yeah, sure.
And I don't know if you want me to leave the paper.
Yeah, give that to me and I will give it to this future father-in-law.
Yep, okay. And actually, Donna.
Oh, okay.
Yeah, I will give it to you. That's the best thing to do with it. I don't think it should be mailed. I think it should go to, then he can give it.
Yeah.
Best way to do it, but thanks for bringing that.
It's a requirement to,
Oh, yeah.
to
Oh,
make
yeah.
sure that he's,
He's probably very familiar with.
Oh, yeah.
the
Oh, yeah.
financial
I'm
industry.
sure.
Everyone gets-
Yeah, he's gonna be, you know, the way that people in a condo association, they have to have all kind of papers and signing.
Yeah.
Mhm.
To look at anything.
Okay, so, before I start, does anyone have any questions or anything off the bat that they would like me to address? Okay, pretty standard. So just from the get-go, you know, I think this year is turning out to be very different than what people had thought. We were not sure how things were going to turn out as far as a soft or hard landing. There's still a little bit of debate over that, you know, and this has to do with the Federal Reserve and how much their Federal Reserve rate increases would be putting, you know, impetus to future growth.
Right. And
really, it seems as though, you know, employment is still really strong. Growth numbers are still good. I think we're sort of in, if there was going to be a trough year or something, it would kind of be, you know, now 2022 is obviously a more difficult year. The big thing now is, so as far as the Federal Reserve, the Bank of New Hampshire, actually for our own budget concerns and things like that, they've made the determination they do not think that the Fed will be decreasing rates at all this year. In fact, kind of keeping them the same. We just had a meeting with our folks at JP Morgan, and we talked to a lot of different sort of, you know, people. These are true economists who still feel that there could be 2 rate increases. You know, they moved from June to July for the first one. I think we could potentially have one. I don't know. I mean, you know, we're not the people with the globe, and it's really, I think it's about being, pardon me.
Even if there was, it'd be like a 0.25.
Well, exactly.
Yeah,
So it would be
we kicked
2,
around,
right,
yeah.
exactly. 25 basis point moves. They're kind of already what we call baked into the market
Right.
anyway. So, you know, they had been. Was interesting in the last couple of weeks. We actually have seen the whole treasury curve. So from short rates are in the 5% area. And then you go down, you know, you go down to the 10-year, that's about a 566, a 466, excuse me. So we still have that inverted treasury curve. But it increased, you know, with the 10-year, I mean, about 40 or so basis points. And the whole thing, the short end is locked because of where the Fed fund rate is. But then the longer end, sort of that 7.5 to 10-year to 30-year, all shifted up. And so rates are at a, you know, a much higher level. The big thing here is, so we're going to discuss today, we've got quite a bit of cash still in the capital reserves. It's over 50%. And we discussed getting that deployed our last meeting. And, you know, I'd sent out some information and things. So I'd kind of like to, it's actually, we don't have to do anything right away because we will be higher for longer.
Right.
Rate wise, and the fund that you're in, the government obligation money market fund, which invests in very, very short-term government obligations that are guaranteed, you know, is currently at a 5.35. The 2-year treasury is at a 5%. The 12-month bill is at a 5.17. The 6-month bill is a 5.36. So you're really pari passu, right, with the money market, obviously 6-month bill. So it really has been a fine thing to have that still in the money market.
But what I'm thinking is, with Matt not being here today, and we won't
make any decisions.
we won't see you because I've got a July date. We'll talk about that later.
Yep.
I'm thinking to have a meeting in June, a work session, which we do without you, and go over some of this stuff with Matt, especially with it missing today.
Yeah.
I think we need that. I don't want to go from today to July. That's too far from. We're not doing it.
Well, so I guess sort of
It's okay for you, but I mean, we need to have a work session.
Yeah, and so feel free to reach out, and I can send you what sort of all the rates are, the treasury rates, where they are out to 5 years, and CD rates, and kind of what I've been doing over the past, several months.
I'll send you an email once
you have a date set up.
yeah, we're gonna try to get a date check. We got a booking. This room is interesting.
Oh,
That's why
okay.
we Thursday morning, but it's usually we get in good without having the battle.
Right,
Kind of a
and bring that up to speed and stuff. So
Yeah.
that'd be
That's right. I don't want
But I
anything
think you're
without that.
absolutely correct in your.
There's no hurry.
Yeah.
Sometimes I'm like, look, we really kind of have to do something.
We're doing
And
well with that.
they're really, I think the last meeting, we were a little bit more concerned
Right.
that
Rightfully
rates were
so,
going to
and
be.
that was everything. Yeah.
Absolutely,
If you
and
don't
now
know,
we're less
they're gonna
concerned
do it.
about rates
Right.
going down. So I think it's fine, because remember, when you have something in that has like a 30, 60-day maturity, if the Fed does start to decrease rates, you'll see that yield come down pretty quickly
Right.
as those securities mature off and they
Right.
reinvest in lower yielding securities. So at some point in time, when we really start thinking that they might be making, more, 25 here, 25 there, it's not gonna matter. But if there is a time where we think that they might start to make some sort of heavier rate decreases, then we want to be, nimble and be able to put more of that money to work quicker, because, well within that sort of 30, 60-day time frame. And that's very, very easy to do. But anyway, I'm jumping ahead a little bit, kind of getting into the
It's sort of,
portfolio,
you
but
listen to the radio and it's like soft landing, hard landing, no landing at all. They're just gonna print money.
and yeah, well, it is sort of, we're sort of floating.
Exactly.
We are, yeah,
Exactly.
yeah.
You don't have a crystal ball, so.
No, and
So-
it's always interesting. I like to say that even the best economists, we do like to confer. We have some favorites that are out there, in the street, and of course, listening to all of the Fed members. But it is interesting with all of their wealth of knowledge and historical perspective and everything. A lot of times, not only do they not get the rate right, what the future rate will be, but not even the direction.
Right.
So it really could be sort of an interesting, again, it just shows that you need to have your portfolio really set to be according to the doctrines of your investment policy statement. And that's pretty much the most important thing. So, and as long as you sort of, continue to have diversification and stay nimble with what you're doing, and have it set to your policy, you'll be okay. So that being said, I think on tab, 1, you'll see we have some bulleted headwinds and tailwinds.
Right.
So I think the big things to talk about obviously are inflation. It still remains above the target, but it's been behaving. It's been sort of wafting up and down, and that's what we think it will continue to do. Some of the things that are contributing to it, for the inflation was automobile insurance, and some things like that. So it's really some odd types of items. Oh,
I gotta walk.
odd types of items that will be pushing inflation forward or back. The thing that we look forward as really something that kind of a lot of people haven't been talking that much about is consumer credit balances. Consumer credit is really on the rise. And in fact, we had our all-employee Bank of New Hampshire meeting, and Chris our president, does a fabulous job of sort of giving his impression of what's going on. And although he says, I'm not an economist, they're seeing, from a banking perspective too, one of the biggest things, the problems coming forward from a banking perspective as well as economic, is consumer credit. That people have, they're not only are they spending more than they have, but interest rates are very high. So it's more difficult for them to sort of, make those, once they get into sort of a credit issue, it's more difficult for them to get out of that credit crunch. And then, of course, the other issue is that they are starting to see defaults, and sort of some cracks and all of that.
I'm just sorry, just for my information. So when you talk about consumer credit, we're talking car loans, credit cards.
Yes. Yeah.
Mortgages,
Yes.
so everything across.
Everything
Across the board. Yes.
Right.
Yeah. And
The
that's,
bubbles
so
everywhere.
it's the
Yeah.
credit, yeah.
Exactly.
So it's not as though we're in trouble, yeah, but you're starting to see the cracks. And of course, then if you start to see, we all remember the financial crisis, and everything, which really sort of started with selling homes to people with very bad credit, and what they also did with the rating agencies, rating things that, creating these securities from mortgages and not really properly having them reflect what the credit really was, all of that and everything. But we I think the lessons learned from that is you really have to pay attention to some of these things, to really have your fingers out there and paying attention to a lot of this stuff before it sort of happens. So we look at that as one of the things that we're really paying attention to. Geopolitical risks obviously remain very elevated, particularly recently with with the attacks, and the things that are being said that of, who's at fault and happening overseas.
No, I mean, and I don't need to interject, but since we're just talking about economics here. So, okay, let's say, because we had such a low rate with the Fed for a millennia or whatever, and it's causing all of these, bubbles throughout the economy, or, I guess we're paying back for all that loose money that we had earlier. But say there are defaults, is my question, in one of the major defaults in any of these areas, is that really going to affect any of the investments that we have? I'm talking about our $6 million or whatever, half of it being in the federal covered 5%. So it's not going to affect half of our money there. And then the other half for our AAA bonds and the, Apples, I guess, or 3Ms of the world, that it's probably not going to hurt them either, right? I mean, in general, or?
So I think your portfolio, yes. And I mean, you do have, obviously, in the trustee of trust funds, there are equity positions, but they're in highly diversified index funds.
Right. Index,
so yes,
index funds. The index,
yeah. So right. So they're so highly, that's the top 500 companies, and I had actually a value fund. So we did diversify even within that, which I sold off value fund more recently, because we're seeing sort of with the growth kind of growth funds are doing better, and we do continue to anticipate that. But no, these are just things, these aren't things that are particularly going to necessarily cause default in your own, holdings, right? But they are things that can sort of start to show crumbling in the economy. And of course, all of the economy then does affect what happens in the marketplace. Sure. So people can start moving out of equities more into fixed income, which is, is a less risky asset and things. So you can see, sort of the S&P 500 maybe go down a little bit, things like that. So when you want to, sometimes if you're in individual sectors, so you might, for instance, or we might, for instance, get into more defensive, like put a more defensive type of a sector fund in there, as opposed to being in a more growth orientated. So if we put a growth orientated fund in there, like information technology during high growth periods, sell that and go into something that's a little bit more defensive. That's taking your S&P 500, which is like this, and as I like to use the technical term, goosing it one way or the other, right, and try to beat what the index is doing, right, and do better for the town's money. Right. But no, none of these things are necessarily going to, affect dramatically, the direct
the town's
that you have.
Right.
So in those are the headwinds, the tailwinds. Equity markets last year we'd seen where it was the Magnificent Seven. Now with Tesla, kind of, what's happening with that called the Mag Six. But we're seeing those 7 stocks, or there were 10, if you, depending how you counted them, really made the whole S&P 500, the whole thing go up. Whereas flat, I brought some charts before, the other 490 4 stocks were flat, were down. So now we're seeing breadth across the board in equities, which is really nice to see. We're seeing more equity stock or more companies participate sort of in the market. We've had some bumpier days here. But overall, I mean, we're still up 8 plus, close to 9%. So really still a great year. We'll continue to see sort of that, that bumpiness. Consumer spending remains robust. Of course, that kind of ties into consumer credit a little bit. But the consumer is the lion's share of GDP, gross domestic product. So that always, makes recession less likely. Strong labor market. Banks remain well capitalized. So that's something as we sort of, it's very difficult during a low rate environment is very difficult for banks. And yet also so does a high rate environment because people aren't, there's still sort of a shock in the economy for high rates that people aren't turning over real estate and commercial properties and some things like that. People are, maybe gun shy of getting loans for their businesses, thinking that rates might go down. Now, I think as we see that this may be higher for longer, we will come to some sort of kind of median. Everything sort of reverts to the mean at some point where supply and demand come to hover. And I think, coming into this, so in the next year, so we'll start to see that kind of happen, which is a nice place to be. And then corporate earnings remain resilient. And that's sort of that hard and soft landing we were talking about. How are all these businesses going to fare on what is going to happen with the growth in all of the economies throughout the world? Really, COVID was worldwide and global. So it's like, how is this all going to kind of pan out globally for everyone? And really, the corporate earnings are remaining resilient, over the majority of them. Do you have any questions?
No, I'm just glad that you said that banks remain well capitalized. That's reassuring.
Right.
Yeah, particularly because of what had happened. Particularly because of, so that's nice. It's sustainability and you have your, so your lights go off.
So I know that's because the lights are on sensor.
Right, so that they're saving electricity when nobody's in the room.
Just so they know.
Yeah, you need a sensor over here, I guess. The sensor needs to be.
Well, sometimes the whole thing about. I couldn't mean it.
Change that.
Yes.
So yeah, it's nice to know that banks are resilient and I guess.
Well, that being said, I mean, I will say that, and in our review, I probably wouldn't say this if we were number 5 or below, but in the top banks, in the banks in New Hampshire, Bank of New Hampshire is, number 1. But we really, Chris, when he was speaking the other day, he goes through the balance sheet with all employees so they understand to the positive or negative. It's been a rough couple of years, particularly, I mean, earnings are down a lot, but the bank fortunately had done things very well. Some other banks, similar to what had happened with the California banks, they had sort of overinvested some of their securities and longer securities and those being underwater when rates, go up. When interest rates go up, current holdings, the price of those goes down. So you get underwater, and those are the investments for a lot of banks. Some banks are heading into particularly much smaller local banks are a little bit heading into more troubled water. And it really depends bank by bank what they had decided to do during that time period. And some of that means too that maybe it's opportunistic for other banks. If there's problems with it, then they become sort of a takeover candidate or something like that. A lot of times, the way that regulations are now, those things are caught well before, well, you hope that they're caught well before they actually happen. And then there always is the government. Hopefully people don't have accounts over $250,000, which is what the FDIC is, comes in for insurance and things like that. So, I mean, there are all of these sort of stopgap measures in there, but generally speaking, like, the banking industry has they've kind of come back from some of those lows. And now that we've kind of mediated, like I said, everything's sort of reverting to the mean again at some point. So Loans will start to be, people will start coming out to want to get money again. You know, you can only stay dry for so long for businesses that want to expand, particularly when we're seeing growth in the economies. Well, you probably see that here. You guys probably had, I know the season probably was slow to some extent, pretty good in the beginning and then slow at the end, but you know, you see those kind of ebbs and flows, you know, with everything.
I'm talking about our local economy.
Yeah.
It's gangbusters, honestly.
Yeah.
You know.
Oh,
That's
the
that's,
eclipse too, that was just.
oh my gosh. That, you know, yeah.
Oh, that was good for the Great North Woods area and up there.
Everywhere. Yeah. Yeah. The only thing it wasn't good for the people that were stuck in traffic, I guess.
Our biggest problem is demographics. We have not enough children.
An aging population. Yeah.
People, no one to fill any of the jobs in service industries.
Yeah. Yeah. I mean, that's always been, even like in Laconia where we have the local college,
Yeah.
you know, that really tries to get people, particularly in what are the, you know, some industries like, you know, tourism, with healthcare, with, you know, things like that. Yeah.
Very difficult.
So let's move on to tab 2 is the trustee of trust funds, the policy. There's nothing that we would suggest changing, you know, in any.
That's a good document.
Yeah, it is. Yeah, so this is the document that allows you and us to be able to manage the money according to how it has to be managed according to the RSA's, you know, of government doctrine and so that it's fiduciarily, prudently managed.
We have to do some tuning of that a few years ago.
Yeah. Well, and that's why
it's running smooth now.
Yeah.
There was some stuff we had to change. Yeah.
Well, maybe we talk about that next meeting. I'd be interested.
Oh, sure.
Well, you know, a lot of times too, as sort of, you know, the economy changes or as the world changes, you do, or as laws change, you know.
Well, that happened too. Get that.
Yeah. So, and then if you don't know the laws change, then
right. And the bank certainly, you know, very helpful with saying you might want to go through it, and we did.
Yeah. So on tab 3, we have, this is actually the trustee of trust funds capital reserve fund. This is the fund which has to remain most liquid and is invested in cash equivalents, which is the money market fund or anything under a year. That's what we call cash equivalents investments under a year, and then other fixed income, you know, securities. And, you know, we generally only will go out 5 years in this. Again, that's, we keep a diversification of, within the investments, and then we keep it very short, under 5 years, keeping it going, allowing to go out 5 years. And most times when you have a regular, a normal, what I call a normal yield curve, which is upward sloping, you get higher yields for the longer you go out. But you know, that is the way that this is managed. It does have, if you go to page, so well, starting on page 1, so 57% of the, you know, 3.6 million is in cash equivalents, money market fund. As I had said, the money market fund, you know, right now is yielding today a 5.35. That's right on top of the 6-month bill. Other assets, again, with an inverted curve, are underneath that. So you're actually behooves the town to have the money right now in this in the money market fund. That being said, we pay close attention as we think that, you know, if we think that short-term rates might go down, then we would want to start investing that.
Right, something.
Locking in rates.
Seriously think about it.
And so, you know, when you have your meeting in June or whatever, I'll send you some rates. You guys can, you know, sort of look at things then. And I'll give you our opinion on it and what we're thinking as far as timing for things. Otherwise, in other fixed income securities, about 42% of the portfolio. Page 2 shows you the characteristics. Obviously, very short maturity, 1.6 years right now. About yield to maturity about 5.25%, so really fabulous. Ratings are A+ by S&P, average and AA by Moody's, so very, very high quality. Again, sort of a bevy of different types of securities, CDs, corporate bonds and notes, U.S. government agency obligations, and then treasury bonds and notes.
So, you know, we never had documents like this a few years ago.
Yeah, yeah.
Before we got involved with, or like chased after to get banks, because we were, you know, said the story many times, we were getting $229 a year.
Yeah, yeah.
That's what we were getting. And that, when I first got on the board, that would have been 2015, I thought it was an accounting mistake. I thought a comma was missing, something was wrong, but then we sat down and then we found out eventually that we weren't even in a wealth management program. This money was just
Sitting.
Yeah, and we had no idea until
Right.
we got involved with Bank of New Hampshire, and they sat down and went over this stuff, you know.
Well, it can be it can create some fear because you were basically not doing anything, so it was just sitting there, which is very safe. It was just sort of sitting there.
It's safe,
But you need to.
but it's interesting when we got involved with the wealth management. The first year we went 229 to 8,000.
We're now $247,188 is estimated income a year on this.
And you're figuring what was that?
240. It's the page 4 of 5 in this tab 3. Right-hand column, estimated annual income.
But it's issue 8, 16, 32,
Yeah.
the 48, the 52, the 78. Now that is fantastic.
Yeah.
When you figure 229, probably next year we might have got 250.
Well, we have to remember that interest rates did go from 1% to 5%. Sort of, you know,
Right.
So that's very, very,
Right.
but you know, even at 1%,
But if
or 1.25%.
we're not getting reports like this.
Oh,
We're
okay, yeah.
not getting investments. This was just, and you know, but this was, you know, I came into this. I thought this doesn't make sense. We need to get involved. What 5 different banks in. Pick Bank of New Hampshire. They got going. We got rolled. Started having one or two meetings a year.
Yeah.
Which I thought was insane.
Yeah.
Was, you know, I wouldn't use the word battle, but it was quite a while to get this through with the board. But look at the results now.
Yeah.
Just look at this document right here. Speaks very highly of the bank.
Thank you.
Absolutely.
Thank you. So I think, you know, one of the things that people comment on, again, we had touched on this with what happens with yields, but there are unrealized losses in this portfolio, and that can scare some people. But these are unrealized, and these are in securities. So these securities have an actual maturity date. So during the life of that fund, if you, let's say you bought it at $100, or this security, supposing you bought it at $100 for, you know, a share of face value, then as interest rates go up, that price might go down to $92. So your security is worth less if we were to sell it. However, as you approach maturity, you get $100 back for all of your bonds. So that means that you're back to be made whole. And in the meantime, you're earning interest on all of that. So, you know, so we really like to kind of make sure that people understand that those, as you approach maturity on this portfolio, all of those, obviously those losses reduce down to nothing. So you are made whole always on everything. In the meantime, you're earning money on all of it.
Well, that's a good example. $100 with 92.
92, and then you get back to $100. Every bond comes back to 100. You know, at its maturity. You can buy bonds over 100 for $105, but that means you're getting a higher yield. Right. And you'd only do that, you'd be getting, let's say, instead of 5% at $100, you buy a bond that might be $105, but you might be getting a 5.25% yield. So actually that extra yield that you're making up makes up more than up for the fact that you're only getting $100 back for that bond at the end of maturity, because you've made more than that difference up in the yield that you're earning. And that's the reason why you would do that. Sometimes people get, but you paid more than 100 for it. So that's the reason why, because you're getting a higher yield than a bond that would be priced at 100. Any questions on the capital reserve account? Okay. So the next account is tab 4. That's the trustee of trust funds, which is more of the long-term portfolio. So in a long-term portfolio, one that has more of a historical, not historical, a line that goes out ahead. What am I trying to? It's perpetual.
There you go.
Perpetual, not historical. A perpetual account. So this you can take on a little bit more risk because over time, equity markets do provide a greater return than fixed income. And for the short term, equity markets can be very squirrely, but over the long term, they continue to go up. So you can afford to take that risk because over the long term, the expectation is that you will return a higher rate of return. So right now there's about 14% or $18,600 in cash equivalents. 46% is in equity and about 39% in fixed income. I had sold some of equity position and purchased to use some of the cash that had been in there to put more into fixed income to keep that more sort of at the less than 50% level for the equity position. And then we have this account is invested in mutual funds. And that sort of, makes fun for an account this size. You don't want to invest in individual securities in an account this size because you don't get the diversification. You would not even be able to buy for if you had, let's say, 50 stocks or so in this. Some of you would be tough to even buy one share if they're trading at $500 a share and things. So you get a much more, also you get just a higher level of diversification in mutual funds.
Got an overview of the whole situation, sounds like.
What do you mean?
Well, the last sentence you just said.
Yes. Yeah, you get a much, so you're invested in 500 stocks in the S&P 500, right. Excuse me, or, if there's, so if we go over and there's some, a 10% position of equities, 10% of the equity position is in international. And right now, actually, that's, not a bad place to do. International had actually been outperforming our own domestic stocks for a period of time. So it's always good, even if you're not necessarily thinking that an area might be great, you oftentimes will continue to hold a smaller position. You'll just trim that position down. For instance, I'd had you in value stocks and I had taken that position down. That's a segment of large cap. And I'd taken that position down because we think growth stocks would be doing better, or the sort of the blend, which would be the regular S&P 500. And then in the bond portfolio, so you have about 50% in short funds and about 50% in other sort of intermediate type funds, or some are actually a little bit longer funds. I had made a conscious determination to put you in shorter credits, shorter term funds, because remember the curve's inverted. So you're going to get a higher yield. You're going to do better in a short-term fund than you're going to do in a longer term fund. Right? Yeah. Mm-hmm. That's what I did. So I think that's kind of all I have to. Oh, the one thing is, again, so actually, if you look at these, if you look at so in the bond funds, there are some teeny little $44 loss in the short-term fund.
No,
the thing,
paper loss. That's not
the paper loss.
Yeah,
it's unrealized. It's unrealized. So one of the things that happens with mutual funds is they take a little bit longer. So you own a basket of securities. So if that fund owns some longer term securities, It will take longer. Those securities are underwater. It will take longer for all of those underwater securities to kind of come off, or for rates to, once you see rates come down, all of those prices of the securities in that fund will start to come up. So you'll see that loss disappear, but or as the securities sort of mature off. But that's the difference, sort of why you want to own individual securities sometimes in a fund like the Capital Reserve account, which has such a short viewpoint, it needs liquidity, and because you really can't afford to have any losses in there. If you did have to sell off something, you do not want to have any kind of a loss. You want to be able to have ample cash there, number one. But in the event that you did want to sell off something, you wanted to have a lot of securities that were close enough to maturity that there wasn't going to be any issue. With a mutual fund, if a mutual fund is a long-term mutual fund, and those, remember, we just saw what happened in the intermediate part of the 7 to 10 year. If you owned a fund that had that and went up 40, 50 basis points, most of those securities would be underwater. And you had to sell that. That means that you'd be selling securities that were longer term, that, you know, you'd be seeing a loss in that fund on. Right. Over time, again, this is something where, you know, we will see that come back to kind of that mean as we see rates come down. And as also bonds mature off and the portfolio manager of the funds is reinvesting that cash into higher rating bonds.
And we're investing into individual bonds, right?
Not in this.
Not in this one. So this is one of those things where I say, I got you.
It's much like a stock that if the market's down, you know what I mean? But you don't use, this is perpetual. Remember, you use the Capital Reserve account for your budget needs and everything like this. This you don't, like there's no cash flow sort of in and out of this. So it's not as though you're pulling, I have to sell things to pull money out of this.
We don't want to stop that.
But I mean, in the future, this is probably not the best investment, right? It just
well, sure it is, because look, it's you know, $50,000 in fixed income. So really, to put in individual bonds, I mean, I could buy positions of 2,000, you know, bond positions of sort of or 5,000, have 10 bonds of $5,000 each.
Right.
But you know, in a situation like this, it's really sort of the most efficient, because as I also said, we're able to kind of get in and out of these funds. You know, nobody wants to take a loss, but if you had to in this account, it's not like the Capital Reserve account that you wouldn't be able to have a loss. It's just part of a loss can be part of the process. If you take a little loss in order to invest in something that's better for the future, for instance, going from a long-term bond fund to a short-term bond fund, I happen to go from equities to bonds because the equities have been doing so well that they keep getting up to that 50% mark. So I have to keep trimming it to keep that within sort of, you know, the proven investing policy. But yeah, I mean, it's sort of an efficient way to do this. And
right. Yeah, I mean, I just, you know, I mean, obviously circumstances, you know, are better to have things in equity now. I mean, not having it in
short-term
things. So I mean, going forward, and like that maturity would go into a short-term investment with a 5%. You know, for the you know, money market rate there.
So so the money market rate is at that 530. I think it's showing 520 on here, but I just looked at 536.
Right. I mean, and regardless, I would say even regardless of the 50%, I never heard of it. I mean, I understand what you're saying, but I don't have a problem going for 50% in cash.
Oh, for the Capital Reserve account. Okay. Good. Well, we're a little bit over that right now. It's 57%.
Yeah, I think that's the best investment, at least.
Right, for the short term right now. And that's why it actually put you into the short term fund in the trustee of trust funds account, the longer term, because it's still, even though right now that's a better investment.
Yeah, I mean, I know the laddering strategy and all that stuff, but I don't know.
Yeah.
We'll talk more than that, but yeah, I mean,
Yeah.
I would just say,
I
we
think
think
you would-
5% and
Yeah.
let it go, and yeah, I think we'd be all right.
Makes sense.
All right, so over the last year, the total portfolio of trustee funds has is up close to 15%. So considering that, I mean, the equity market, that's from March 31 of 23. Oh, I'm sorry, tab 5. I'm looking at the first tab is the capital reserve fund, which is basically, you know, sort of money market and 50% in fixed income. Over the last 1 year period that goes from March 31, 23 to March 31, 24, so last 12 months, is at a 4.51% return. And you can see going back even sort of since the inception of 2019, it's a return of 1.33, and that just shows you how low rates were at that point in time. And then the following page is the trust fund account. And so over the last quarter, it was up 5%. Equities were up, you know, about 10%. Fixed income was actually down. Now, when it talks about down, that's on a total return basis. That takes into account income as well as price change. So the reason why there's negative here is because remember that unrealized losses because price change, because yields went up, prices went down. So the total return, you've been earning interest in all this. You haven't had a negative, you know, your total return is prices, but like I said, we don't really care about prices because that's distressing sometimes to people to see that. So your yield has been 5.25%. But, you know, because the prices have been down, that's what total return takes into effect. But over the last year, again, close to 3% for bonds and close to 15, just under 15% for the total portfolio.
Good.
So I think that's all I had.
Right.
Did you want to set a date?
Yeah,
We usually.
I'll go to July 18th.
I don't have anything. I will check, make sure with Frank.
July 18th, that would be 3 months, and that's a Thursday. If I'm correct. I think that's
I'm on vacation in August. That's me.
on vacation in August, you think?
Yeah, in August I go.
Okay, we'll be doing that thing in August.
And just again, let me know in June if you want some information from me. I'm happy to get some.
Yeah, as soon as we get this, well, I want to get this locked up. The date today would change.
And we look forward to meeting Matt.
Yes, hopefully he'll be.
Yeah, he's sharp.
Yeah, he is. You'll like.
It's great to have different perspectives, you know, on any kind of a board or committee.
Well, that's it. You need
people with different backgrounds.
Various backgrounds.
Yeah.
They don't want 6 of any one.
Well, all finance people come with a financial perspective, and sometimes, you know, it's great to have businessmen, and it's great to have people, you know, from all different sorts of.
They don't want 6 accountants, 6 lawyers.
Yeah, exactly.
No, you know, nothing against, just saying, you know.
Right.
I'd rather have.
Diversification.
Right. We've got it on this board.
Yeah.
Up team, which is good.
Yeah.
And the budget committee doing that.
And I do appreciate these reports.
Yeah,
a lot.
Good.
Yeah, this is.
You're very nice.
So you okay with that?
What's the
July
18th? Yeah.
All right,
yeah.
I'll get back to you on Frank.
Okay. Okay, so I will get back to you. So we lock in the 13th of June. I want to check that while you're doing it.
13th of June.
13th of June. I think that's for a work session, correct?
Just send me a note so I know
Oh, yeah.
that you
And then
decided
you
close
give
to the
us-
date. 'cause
And
it
then
might
we can,
change.
I don't want Matt to go up to now till July, it's too long.
Yeah.
Mhm.
Well, thank you, ladies,
Thank
appreciate
you.
you.
It's a
very
beautiful
welcome.
ride. up.
Nice.
We'll have a great ride back down.
Rush right back to work, we know that.
That's right.
We always say that on. to make
Well,
sure-
actually, I was a tourist here and at the, what was the name of the resort?
In season?
In season.
In season?
And my friend left her air purifier there. Funny that she needs it, but she has really bad allergies.
Yeah.
So anyway, so I have to go tootle over there. again. So, you know, we're both sort of, I guess, an employee of the town as well as a tourist here.
That's
So-
right.
All right.
Thanks.
Thank you. Bye-bye.
I'm putting a page into the.
I know.
Anyway, safe trip back.
Thank
Take
you.
care of yourself,
Take care.
right? So did you?
Oh, we're gonna talk a little bit.
Finish.
Okay, right.
June, yeah, it said make sure when you close it, says close all. So
Oh, okay.
I'm sure you did last time.
Okay.
Yeah, let's get June 13th out of the way first.
Yeah,
I'm figuring a work session.
yeah, I don't have any in my.
Okay.
Not that I put everything
All right,
in the
I will-
calendar, I'm trying to.
All right, I will check these dates, make sure we. But Jane said Thursday is great because nobody needs Thursday. which is fantastic. Okay, we'll do the minutes. Thank you for bringing it. I'm still having printer problem. I have somebody looking at it today, in fact, some major printer problem. Okay, this is the minutes for 3/21/2024. When Matt was here to introduce himself, we all did. Are there any questions about the minutes?
I read through them, they look fine to
I think
me.
it looked good. The only thing I would say, we need to put in the time that I missed that before, the time we begin and the time we end. That should be it. Other than that, I think that's great, and I wouldn't change it for that in the future. Okay, do I have a motion to approve the minutes?
I'll make a motion to approve the minutes.
Okay, I will second it. We've already had a discussion. All those in favor, signify by saying aye. Aye, opposed, abstained. Minutes have passed. I will now sign them. Give them to Jane on the way out. Sign them right now. Approved on 18/24. There. I will deliver the client review and Matt's paperwork to future father-in-law, and you can give them to him. I think it's too long to go till July with Matt. That's this week.
I don't have a problem
Yeah,
meeting. I
no,
mean,
I'm just saying.
up the street.
No, I'm just saying, I want to make sure that I have no trouble with meetings. I think that's what. For that, but I think that's.
I think it's good, especially, you know,
The needs of.
I almost missed something when we were talking about bond fund.
Okay.
And Matt would have picked that up immediately.
Yeah.
It took me a couple of minutes to figure it
Yeah.
out, and so it's nice to have.
Oh, he's got my background.
Right, exactly, and
He does.
he would have picked that up instantly,
Right.
and it took me a couple seconds to figure it out. So, yeah, having Matt up to speed on all this stuff.
Well, that's something we had before too. When the victim was on, he was asking about the losses, and then Frank explained these are paper losses.
Right,
And I
right.
really, well, if somebody looks at it, they're gonna say, oh, you're losing money.
And it took me a little bit to figure that out as well, yeah.
Yeah.
In the lab.
Yeah, it's paper. It's not really, it looks at, if you look at the book, oh, yeah, what's going on?
Well, right, and that applied today, obviously.
Obviously.
So, yeah, there's a difference between buying individual bonds and buying an EFT or mutual fund. Or
Absolutely.
ET.
Absolutely. Excuse me, any old business? I guess we just discussed it with meetings. We'll get Matt up to date on. And we'll discuss this, what we're gonna do, but right now, that money is making so much money.
Or maybe, yeah, and you know, and I think we need to discuss in our next meeting, there's a couple things I want to discuss. One is the ESG policy again, which I haven't worked on, but it's a do or dies thing, but I think we do need to get that into the policy. And then we do have to, on our way out, we do have to talk to Jane about monies, upcoming monies that the city needs as far as the $200,000+ that they mentioned to me.
Yeah.
So I think we need that.
Yeah, that's good. That's got to come. They've got to officially.
And then finally, which I didn't realize they brought up today about this, I would call it arbitrary 50% position in cash funds.
Right.
And I think that is something I think we should have a lot more flexibility on, given how much we're making. 5.36%. We want everything in there, honestly. It's fully backed by the United States government, so
yeah.
Why not? You know,
right.
We can always buy bonds in laddering positions anytime we want to. You know, they're not really.
That's why I don't want to go and do without Matt today.
Yeah, no, exactly. And Matt would have a lot more insight into that.
I'm sure he's going to agree that we should do something with the money, but right now it's doing well. So
yeah, I don't want to randomly throw money into different percentages.
No,
because you know, that's what we've always done. Or you know, I mean, maybe that made sense. You know, 5 years ago, 2 years ago, but things have changed. And going forward, we want to maximize our profits. And $237,000 a year, is $237,000. $100,000 a year. It's a heck of a lot of money, and
so it's nice in 2015.
It'd be nice to say underneath this next, you know,
without
3 years of tenure, it'll be, you know, $750,000, or you know, over $500,000 over your tenure. I mean, you know, about $1 million. You know, so that's the ball we want to keep rolling.
Exactly. We're on a terrific roll, and we've got people that have got the background, obviously both of you guys, and we're doing the right thing. We're absolutely doing great. We're just trying to, and we're not really we're not cherry picking. We're just finding areas that we think
we can need
some fine tuning. Exactly what I was thinking of, and sure, you and Matt, we're gonna be able to do that. I just didn't want to rush it today. I don't think
we're in a great spot.
Yeah,
that's how so.
I don't, because he rushing it, I don't want to cut him on something. He just knew what was involved.
And we dodged a bullet by being deliberative in our decision making.
Oh, absolutely.
You know, and the Fed said, "Oh, doesn't look like it's going to happen this year." It's like, well, that's fine with me. That's just more money in the bank for us.
That's right. I totally agree. Okay, new business. We've already set that up with check with Jane on June 13th. I think we are ready for adjournment. Unless there's anything else you got.
No, just those points.
And hopefully, Matt will be with us, and grandmother will be doing better, and he'll be right here with us and going over some trustee information, and we'll be continue on this road. It's a fantastic road. I would never believe that back in 2015, 16, I would never be in this kind of financial shape, but it's great. It speaks about the people on. Yeah. Okay. I want to take a motion for adjournment.
Yep, motion for adjournment, and
second. Any discussion? I don't think on the adjournment. Let's go with that though. All those in favor, by saying aye. Aye. Oppose, abstain. And we are done at 11:08. And Matt is going to watch this and do the minutes from this. That's it. And thank you, people of Lincoln, for watching this. Shut that off.
Let me see. What did she say?
Yeah, she put it interested. All. I want to see this. It flips up.
What do we get? Just the end.
It says end, and it should say end all.